Hello, fellow RoboCapitals. Hope you're well. I'm here with my good buddy, Patrick Ceresna, and we are going to go over some charts today, some technical analysis. I don't really get into this that often, but I think it's very important. We're going to go over charts on the dollar, gold, Bitcoin, S&P 500, 10-year Treasury. I mean, we're going to run the entire spectrum here.
Absolutely.
And the chartist, Patrick Ceresna himself, is here to tell us what he sees in the tea leaves here for the short term and the midterm. So Patrick, welcome back, buddy.
Thank you.
You want to dive right into the S&P 500?
Let's do it, bud.
Okay, cool.
So here we have that chart on the S&P 500, and we have the market trading literally at its 52-week high. So we have a market that, and a lot of people asking the question, is this going to be a topping formation, right? Is this going to be
yellow a moving average?
Yeah, that's the 50-day moving average on there. And so the question is, does it appear put in like a double top? Does it become the head of a head and shoulders pattern, or are we going to have the resumption of the upside as, let's say, this breaks out and starts running? I'm going to change the color of this arrow to something more visible. But are we going to get a bull breakout of a continuation pattern to the upside of the market? And that's a great puzzle to solve. Now, first of all, when going back to understand, we have to reflect on what happened over Christmas. So over the holiday, the S&P 500 was relatively flat in this entire window of time, but it was very deceptive because you had a Mag 7 rally where the all of the Apples and Nvidias of the world were all ripping higher in this extraordinary bull run that was keeping the market elevated. But we saw a massive deterioration of market breadth to the point where during the December, here, I'll just pull this out, during the December decline, we got down to about 18% of stocks above their 50-day moving averages. In other words, we literally had 4 out of 5 stocks declining. Wow. In spite of the fact the S&P 500 was trading near its 52-week high. And that was largely because the Mag 7s are just that big of a market cap that, in spite of the fact that there was this big, broad sell-off in the markets for over a month or more, that it was hidden by anyone who's just looking at what the S&P 500 is trading at just on their phone, looking at where the price levels are. And so this can be seen by going to the same S&P 500 but calling it equal weight, which is basically, instead of Apple being market cap weighted as this huge massive component of the index, it's just it's now giving it the equal weighting as the 499th stock in the S&P 500. And what you can observe is that this was where that big, close to 10% market decline happened in the broader market, where the breadth deteriorated. And so we had actually a pretty violent correction under the hood. It was
very December, Patrick.
That was over Christmas. Yeah, that was throughout December, going into the first days of January. And what's interesting is that while the S&P 500 is trading, the market cap weighted one is trading along 52-week highs, we're nowhere near highs on the equal weight S&P, which basically, in my mind, is continuing to show that this market doesn't have a breadth. It's not wide. Like if the stock market is going to have a big rally, it's going to come under 2 conditions. Either one, the breadth of the market widens where 8 out of 10 stocks are ripping, and this thing is advancing as the tide is rising, and all boats rise with the tide, right? Like it's taking the market higher. Or you need the Mag 7s to rally. You need those big mega cap stocks to rally, and they have been awful. Look at, like, Apple is stuck a little bit of a rally, but it's been stuck in the mud. Microsoft trading down along its lows of its trade range for a half a year. Google gap down on its earnings. Amazon started to weaken off of its highs. Nvidia obviously had that really bad news associated with DeepSeek that caused volatility. Tesla has been giving back almost all its gains over the last many months. And so we have a scenario where, well, are these Mag 7s going to be the leadership that can take this market to the next level? And so if you can't put together a case that either the breadth of the market is going to widen in a big way, or that the Mag 7s are about to start ripping, then the stock market is at a high. Like the only way we're going to go next level on the S&P is if you can conclude that one of those two scenarios is happening. And right now, there's zero evidence of either of the two. And therefore, I'm highly suspect about the market here unless one of those conditions happen. And therefore, as the market is up here, I'm actually concerned on the short term. The momentum is basically gone on there, and there's now rotation out of U.S. equities and finding places like Europe. Like Europe is running away like it stole something. Like look at this rip on the Euro stock index. It's like they basically are saying like Europe was uninvestable, and yet suddenly Europe is had one of its most extraordinary months in a long time. And I think that this is in part
to Chinese tech doing really well.
Absolutely. Like you could look at the way, let's say, K-Web is ripping. You can see the last month has seen like this basically since January. You have basically a 30% rip on the upside of Chinese tech.
You know who nailed that is Chris McIntosh, our good buddy.
Nice.
Yeah, he absolutely nailed that.
The point being that everyone was all in on U.S. equities at the end of last year, and suddenly the U.S. equities have stalled out, and that money is suddenly going international. And that almost makes sense because I think Trump is disrupting enough things where people are looking to diversify. I don't want to say that they're abandoning the U.S., but if you were grossly overweight the U.S. and had no exposure to Europe and no exposure to China, why wouldn't you say, well, no, I got to bring that into the mix. I got to take my massive overweight into U.S. equities to something more equal weight, and I'm going to put some money in other places to make sure that all my eggs are not in one basket. And that's
those other places were really cheap, weren't they?
Exactly.
Yeah.
And so to me, this is actually something that to continue to watch whether it happens, whether the U.S. equities start to stall out and a lot of these international places start marching to the beat of their own drums and keep running a little bit more. The other factor to kind of put into the calculus is trying to figure out how bullish everyone should be on what Trump is doing. Now, listen, politics aside, whether you agree or don't agree with what he's doing, the bottom line is, well, I care as a stock market analyst, what does it mean for the markets? And when he's playing this role of a disruptor and introducing tariffs and higher costs, the natural byproduct is uncertainty for business. Yeah. Businesses are like, well, we have to see what happens before we make our next big moves. And the question becomes, is that during this difficult period where he's trying to renegotiate all the global trade agreements that have been in place for decades prior, what if that actually becomes something that slows the economy? And what if that drives, for the first time, a spike in unemployment because people are not hiring in that uncertainty? And all these little byproducts can happen. What if corporate earnings get impacted and we see contraction in corporate earnings? All these different things could actually spur a market correction. And everyone on the surface is like super bullish because he's pro-business, he's pro cutting taxes, all the things on the surface that make one naturally want to be bullish, a Republican government. I don't know if it's as bullish on the short term as everyone's making it out to be. And the question then becomes, does this translate to some sort of a corrective cycle in the markets? And so right now, I have a famous saying, George, I always say, it's in the markets, I will say, nobody cares till everybody cares, and then they all care at once. Yeah. And so a perfect example of that was going into COVID. We had the Jim Biancos coming on to Macro Voices, and we were like, this is really bad. This is not good. And yet the stock market's trading along 52-week highs. Everything is fine. Everything is good. And then suddenly everyone all at once was, oh, wait, this isn't good. And then they all sold all at once, and it creates a crash environment. And this is a very typical thing. And so I'm curious whether right now, as this market is trading here, everyone's like, oh, everything's going to be fine. Everything is good. There's no issues. But then there's this one moment, whatever the catalyst is, it's always some one little trigger that in an unstable market environment, like, the straw that breaks the camel's back, something just happens and the sentiment of the market completely shifts. Maybe it's NVIDIA's earnings. NVIDIA's earnings are coming up in a couple of weeks, and it is probably the most anticipated market event of the next few weeks, and maybe it will spur enough sentiment shift to drive potential market volatility. It's 100% on my mind on the short term. Now,
so looking at asymmetry, what you're saying there with this chart and everything else that you've pointed out is upside, maybe a little downside's probably greater. So your asymmetry there is to the downside.
Absolutely.
And then the probabilities based on what you're saying is that that downside will come to fruition. So
let's say realistically, if there was a nice clean bull breakout here, let's say there's a solid 300 S&P points upside potential. So you got a 5% upside potential in the bull outcome scenario here along these highs. At the same time, any market correction, let's just, I'm going to zoom out a little bit here on this chart and just reflect that just since the low a year and a half ago, back that October low where we put in there, if all we did was a correction that gave back half of those gains. We're not talking about a devastating bear market that basically goes to, like a 2008 financial crisis. Just a sell-off that is deep enough to correct half of all the gains. It's just not even all of them, just half the gains. Well, that would essentially be a market correction that would be a 17 to 18%, 1,100 S&P point pullback. If it was just that type of a modest correction. So one of these kind of 10 to 20% declines. So to me, that's your asymmetry. You have a 5% upside versus a 10 to 20% downside risk. It's not that favorable. Now, this is where you've had me on talking options before. Well, this is where those that are long the market, it is logical to carry tail risk insurance. Like you buy some sort of put insurance on your existing equities, then you don't have to sell. You just are sacrificing some potential gains to buying the insurance in order to have a definable downside risk. That kind of a scenario, I think it makes a whole lot of sense to be insured in this market environment.
And Patrick, just to be clear, where you would change your base case is if you saw breadth increasing or you saw a bull breakout.
A bull breakout of the Mag 7s. Remember, either it's got to be, so these Mag 7s are so huge market cap that either they're going to be able to move the market on the upside, or it has to be the remaining of the stock market has this huge broad participation where they all rally and advance the market. But the idea that you can have such bearishness in so many sectors and the Mag 7's not rallying, there's just no way the S&P index will be able to get off the mat. There needs to be some sort of a driver that makes that next move, and it's possible. I don't want to just say that the bear case is the only outcome, but there's a lot of very bullish things that have to happen for that upside to be open. The one thing though, right now, George, I'm going to give you my favorite analogy to how I like to think of the markets. And I like to think of it like playing football. And the two football teams are the Bulls and the Bears. And only one of the teams can have the ball in possession. In other words, one team has the ball and they're making the offensive drive, and the other team is playing defense. So in this case, you go through a checklist of for instance, the market. It's making higher highs, higher lows. It's above all its moving averages. All dips are keeping bought. Right now, the bulls are playing offense. They're still in possession of the ball. We can't be outright bearish until there's a turnover. Like there's got to be a point where either they've run out of downs or there's a turnover, and then you see that the bears have taken control and are playing offense. And
so
then
going below the 50 moving average and then breaking through support levels.
Absolutely. And so to me, that level is around that 5,900 to 6,000 level, just below that moving average. If we saw a market that's getting hammered below there, then there was some sort of a turnover, using the football analogy, and then you got to see whether the bears can make any ground and how much yards they're going to gain on the other side. But right now, there hasn't been that turnover. And one of the interesting things that I talked about with Kevin on the market huddle is, like, what is it that will differentiate a 5 to 10% market correction versus this being a nastier 10 to 20% one? And the difference is in credit spreads. And this is junk bond credit spreads. So you're talking about how much premium is being charged or being paid to own one of these junk bonds over that of a Treasury bond, which is theoretically
same maturity.
And so same maturity. And so right now, when we look at the credit spreads right here, we remain about 2.65 decade lows. It's actually not been any tighter. Right now, there is zero risk premium being put into junk bonds because everyone is complacent and it's okay. The point is, I like to think of it like a canary in a coal mine. Like, this is where if that canary dies, you know something's wrong. But right now, the analogy that me and Kevin is like the canary is alive and singing. Everything is fine. The credit spreads have not yet given a warning sign. And during 5 to 10% market corrections, you might not have credit spreads move at all. But almost every 10 to 20% market correction has credit spreads blow out, or there's some sort of spike. And so when you want to watch these credit spreads carefully, because they will give you a cue as to whether this is going to be a big one or just a little correction from an overbought market. And right now, there is no sign yet that the market is, from this perspective, worried. And this is why
what was that last spike up? Was that March of 23? My guess.
This spike, no, that was the yen carry trade unwind, where we got that spike up toward 4%. So that was the last kind of major scare that this market had that caused a spike. But yet here by October, November, we're at these incredibly tight spreads. Look at the 10-year. Like, we have not seen credit spreads this low at any point in 10 years.
Yeah. Like,
this is insane to me. Anyway, so to me, this is a canary in the coal mine, and the canary is alive and singing. So we don't have that evidence saying that something is wrong in the markets, and so that's one of those things your listeners can 100% keep a close eye on, because at some point this market is going to have a 5% correction. It just always does. But is that going to turn into that 10 to 20% kind of nasty drop? The credit spreads will tell you that. And that's what I think all your listeners should be watching closely.
Okay. Do you have the chart of gold pulled up?
Yeah, let's do it. So gold down $50 today. So gold had a great run. And as we approached 3,000, it was finishing measured moves. Gold, like any other market, will pause after a big advance. And so we're now going through a pause. In the past, typical pauses in gold would be $100 to $200 an ounce when gold kind of just does some backfilling. So that could be a move down to 2,800. And so for us to, let's say, see even $100 more on a pullback would be par for the course. We've seen that so many times in the past, and it means nothing to the technical trend. It's just a buy on dip opportunity. So gold is clearly started some sort of pause. To me, this is going to be the big tell. If all we do is see a move down toward 2,800 and the buy and dip traders come and lean into it, then we're ripping north of 3,000 on the next leg, and it will really get going. And so watch for that. I think 2,800 is a very interesting buy zone for people that are looking to add to their gold positioning on a little bit of a consolidation. What's more interesting though to me, George, is what's happening in silver. And because gold is being accumulated by central banks aggressively. Well, listen, when you have a scenario where Trump has talked about forcing foreign debt holders to convert their Treasury bond. This was that Jim Bianco interview we just had on Macro Voices. We were talking about forcing them to take, some sort of perpetual or 100-year century bonds at zero interest as a way of them managing that debt. I mean, a lot of these foreign central banks are like, why the hell are we going to own this versus physically putting some more gold on our books? And so there's been a bid by central banks buying gold for a while now, and I don't think that trend is over. But central banks don't buy silver. And this has been where there's been a huge divergence. There hasn't been a big push in gold miners. There hasn't been a big push in silver and platinum and palladium as well. So look at silver, still within its 3 to 4 month trade range. Platinum just getting off of the ground from its lows. And even palladium also just barely turning up off of its lows. So gold has been marching to the beat of its own drum, and it's left all the other precious metals behind so far. So the big puzzle to solve is are we about to get into a meaningful precious metals rally where suddenly all the precious metals start to participate? And to me, I think that all happens with gold breaking above 3,000, because right now there was the amount of investors that were out there that basically said, I'm selling all my gold and I'm just going to buy Bitcoin. You must know a bunch of them. And in terms of people that have made that call, well, it's been a horrible call for the last 2 months. Gold's been ripping and Bitcoin's been stuck in the mud. But the thing is that there might be a point where if gold breaks out to fresh new highs and is running, then suddenly there'll be a chase for all of these things like silver and other things where they might start to really meaningfully break out. The key is, if you believe in that thesis, silver hasn't even begun. Anyone who thinks they've missed something, you've missed nothing. Silver is still deep in its trade range, and if silver breaks out here and meaningfully goes, you're talking about $37 to $40 an ounce on the next push if the breakout sticks. And so I'm not opposed.
Would you like silver better, or would you like the miners better?
Well,
assuming gold breaks out like you're talking about.
Well, miners going to have more implied. Like this, they're going to be more volatile. So you're going to get more bang for your buck on a percentage basis than silver. But silver is an actual precious metal versus owning companies. So the rationale of which one to own is a little bit different. So as a pure trader, if you want you can also substantially leverage silver more than you can gold miners. And so it all is just a way that you put on the trade. Arguably, if they both work, it's just all about how you built your position that determines what your returns are in both scenarios. So I don't think we have to pick one or the other. The bottom line is, will they run is the puzzle to solve. And that to me is all about whether gold gets bought on dip during this pullback. If we see 2,800 held very well and it rolls up, if we're clearing 3,000, it's going to be like headline porn for every single media outlet that's going to that is going to like just be talking, holy cow, gold's on our way. And then suddenly everyone's going to get that FOMO of shit, buses left the station and I'm not in. And then that could build a life of its own. And so the question is, are we going to see that? And that might come in an environment where if the US dollar starts to get tired and heavy from its run, if we see interest rates suddenly come off, suddenly the two kind of things that have been holding precious metals back, suddenly they're not holding it back anymore. And suddenly it's like, it's like trying to run with the two heavy bags dragging behind you. Suddenly you cut them loose. They're no longer holding you back. Suddenly the acceleration could actually be meaningful. Anyway, they're all in bull trends, so it'll be very interesting to see whether or not that can continue here into the second quarter of the year.
Okay, so on the chart, on the gold chart, really focus on that 2,800 point, assuming that we go down here in the next couple weeks.
Yeah, and no, and conveniently, the 50-day moving average is right there. So I look at it from a Fibonacci level. I look at it from where all the previous highs were. But basically, you want to see that this thing, when it pulls back here, that the buy on dip traders lean into it and then drive this thing for a bull continuation, and that will be the most important part on that front. So let's though now talk interest rates.
Keep in mind, guys, we're going to talk about the dollar, which is probably the most important thing we can talk about. No, I don't want to talk about that now, Patrick.
Okay, let's go.
I just want to kind of tease that and let people know that we're going to be talking about that.
We have to talk about the dollar for sure.
Yeah, and oil. Yeah.
So what I want to talk about is the fact that we had this rip on the upside of yields, which basically anyone was long 10 and 30 years treasuries or TLTs had a very challenging last 5 months as all of these things pulled up as yields ripped. To me, this rally in yields makes no sense. I don't believe interest rates really structurally have room to go much higher unless there was a fundamental change in the macro conditions from what they currently are. Now, there could always be the unfolding reality. Something happens and you have to recalculate. But under the existing conditions of a Trump administration and the world and the current state it is, I just don't see the scenario where we're going to be north of 5% on interest rates on the long bonds. And so to me, we're very close to the bottom range of bonds. But the question more meaningfully is there room for a really big rip? And now this...
I just want to clarify, Patrick, a rip in price and a decrease.
Yes. So let's put it on the TLT.
Yeah, the reason I think you're saying this, correct me if I'm wrong, is because you are in the camp that what drives yields at the long end of the curve is growth and inflation expectations, as opposed to just the supply.
Yeah,
because there's a lot of people out there, and a lot of smart people that really get focused on the supply side. Like, look, the deficits are exploding. Basent isn't going to issue as much at the front end of the curve, and therefore we're going to have a lot more issuance at the long end. And that's their kind of bear thesis for yields going up, prices going down. Where I think you would be in kind of my camp, where it's like, nah, I don't see any evidence that supply really drives yields. I think it's more about inflation and growth. And when I look into the macroeconomic outlook for the United States, I don't see this reacceleration like we had in 2021, 2022, where we go, although we have gone from 2.4 to 3, it's unlikely that we go from 5 to 9 to 12, like something like the 1970s. And therefore, the yields may be ahead of themselves, so we could see a decline back down sub 4, which would be more in line with what you think growth and inflation expectations will be over the next 6 months. I don't want to put words in your mouth. But.
No. Listen, you could you construct a macro case that is framed that way. So, but let's talk technicals. To complement that, right? And so here I put the TLT and I put it on a little bit longer term, so you can see some of the lower years. But the way that I would translate it is that there's a very good chance that this will be the bottom. Is that short?
I can't see how.
This is 2024. So by the way, here, this is the huge bond bear market that happened from 2020, where we basically saw almost like a 40-50% wipeout in treasury bonds on the long bond and that vicious decline. But you can see that it's starting to look like a bottoming formation that we've now created the lower boundary of this. And I think this is the way to approach this thesis, which is I don't want to fall into the trap of trying to make too big of a macro call, like we're going back like last decade to 0% interest rates. There are people that want to make those calls. Let them make it. I want to look at it as a trader. As a trader, to me, I don't see any reason why we can't go to the same levels of bonds and interest rates that we were at last year.
Yeah,
And
so
last year,
3.8, right?
right. And so, or even the one in 2023, whether you're looking at TLT going back to 100 or TLT returning back to 110, I don't see any reason why we can't see those levels this year. And
Well, that's
so,
good because I've got calls at 110, I think.
right. Exactly.
That are about a year out.
And so we have a scenario where I think that these things can move. But the bigger question is, let's talk about which are the two ways to express our views on interest rates and bonds. One is playing the long bonds, which is the TLT, and it's a play that generally disinflationary pressures start to emerge, economic contraction starts to emerge, and generally the level of interest rates and inflation expectations on long duration inflation expectations start to come down, allowing bonds to have this big rip on the upside.
Yep.
And so that is a macro call on the economic circumstances. But at the same time, this is not necessarily the best way to play what you believe the Fed is going to do. The Fed is all about shorter term interest rates. And this is where we can talk about SOFR futures and 2-year yields and other types of shorter dated ways to play this. Now, obviously, SOFR futures have replaced euro dollars. I'm sure many of your listeners have heard Eurodollar University, Jeff Snyder, talking about this. So SOFR futures are his universe. Like, this is where interest rates and all function on that short term. So some really interesting observations I want to make about what future interest rate expectations are being currently baked into the market.
Yeah, and
So,
Patrick, before you go on, I just want to explain a couple things you said there, just for people who might have missed it. You're talking about that, you can't really look at the front end of the curve there. And a great example is the Fed has dropped rates by 100 basis points since September 18, 2024. And during that time, we saw the 10-year Treasury yield go up by 100 basis points.
right.
So you can't just sit there and say, well, the Fed's going to do X and therefore the long end of the curve is going to do Y.
Yeah. So, and to speak to this point, that you could look at the yield curve, right? Which is, here's your 2s, 10s, right? And we obviously spent almost a couple years trading at inversion, where we were below 0% on the 2s, 10s curve, and we've now steepened, which is often actually a sign that typically is interpreted bearishly, as bull steepeners tend to.
Yeah, that's usually when you get the recession
and the Fed cutting, because most recessions happen during Fed cut cycles, because the Fed realizes the R-star is much lower, that they've slowed the economy too much, and they need to start easing aggressively, causing short-dated interest rates to collapse, short-dated bonds to rally, and allowing this 2s, 10s to steepen in a big way. And that is the play on that. So let's talk briefly about what markets are currently pricing in. And so the first thing I want to start with is looking at March SOFR futures. And so now the way, George, that your listeners can think about how to interpret the price level is take whatever price level this is trading at minus it from 100. So to get the interest rate. And so with this trading at 59.70, sorry, 90. So I'm being dyslexic here. 95.70. If it's a 95.70, but the difference between 100 and 95.70 is like 430. So the current interest rate is 430 basis points that's being priced until March.
The current projection, right? And just to be real clear, guys, the SOFR rate pretty much replaced LIBOR. So it's basically the SOFR is telling you what the market thinks the Fed funds rate will be in 3 months, 6 months, a year, et cetera.
Exactly. They're basically pricing in future interest rates all the way out. And these are short-term interest rates.
Fed
so this
funds.
is Fed, well, 3 month. This is particularly 3-month rates, not Fed funds, but it's still going to be influenced by Fed funds, right? 3-month rates is a very, very short-term money.
Okay.
And so the point here is that they're pricing that in. So now let's go to the end of the year. So let's go to December of this year, and we are trading here literally at 96, which is 100 minus 96 means that's a 4% interest rate.
And you said this is projecting out a year.
Yeah, to December, to the remainder of the year.
Okay, the remainder of the year. So December, the market is saying they think the 3-month T-bill will be right around 4%.
Yeah, which basically means that they're looking for one rate cut. Right now, currently, the anticipation is at some point there's going to be one more 25 basis point rate cut coming in this year. Now, go out even 1 year further, and you have December of 2026. Now, 2 years forward.
Yep.
And it's still at 4%.
Wow.
So what we now have is a SOFR futures market that is currently so uncertain about the interest rate path
that's frozen,
that they're frozen into saying that we right now they're pricing in a Fed that does not act for the next 2 years.
And the probability of that is almost zero. And not saying that they'll go down. I mean, I think they'll go down, but maybe you want to argue that it's going to go up. But I can almost assure you in 2 years, it's not going to be the exact same.
Right. And this is where I think there is an amazing trade, because whether you go 1 year out or 2 years out, there was two events that happened in the last year. Let's call it the last 15 months. That where when the Fed was initially indicating pivoting back, and that started that huge October market rally back in 2023, we had the market go from pricing in 0 cuts to pricing in 7 to 8 rate cuts in literally just a few months. It was one of the most extraordinary rallies that we had in SOFR futures, as they basically went and started to price in a super dovish Fed.
Right.
Then, when everyone realized that the Fed is not going to be remotely as dovish, they literally pulled all of the interest rate cuts back out of the market by May. So by the middle of second quarter, they basically went and pulled all 7-8 rate cuts out. Then comes the summer, and we have the Japanese yen crisis there that happened with the where we basically had the carry trade blow up.
Yeah.
And suddenly the market went in and priced in another 8 rate cuts almost immediately, like the world is ending.
It's just totally bipolar.
Yeah. And then
they're pausing, they're cutting, they're pausing.
Yeah. And then now they pulled it all back out.
Yeah. Yeah. Now we're back in pause mode.
And so in my mind, I'm like, okay, we got Trump hammering tariffs, huge uncertainty about things, the whole world going through all of this kind of uncertainty about how things are going. There is so much room for there to be economic contractions. Now, let's not call it a 2008 financial crisis. Let's not call it some doomsday scenario. But the chances that all of this trade war stuff actually slows the economy can happen.
If at any, have to point out too, Patrick, that the United States right now is the outlier by far, and most Americans don't realize this. But when you look at Canada, China, Germany, Eurozone, UK, I mean, these economies are very, very close to not, if not in recession right now. I mean, China's going through basically a GFC.
Yeah.
So you got to remember, Americans, that the United States, they are, again, they're the outlier. So, is it outlandish to say that the United States, there might be a slight probability that the United States will join the rest of the global economy that, as we know, is very interconnected? I think that's got to be a part of the analysis as well.
Absolutely. And so, to me, one of the big trades is anticipating that the market at some point will go back to pricing in a Fed rate cut path that right now has been completely pulled out of this market. And therefore, you can, and the amount of leverage that one can attain in SOFR futures and or options on SOFR futures is extraordinary. I would argue If you,
and then also talk about the liquidity, because remember, that's a mistake that I made that you and I
yeah,
have discussed.
it's
The great thing about SOFR futures is,
most liquid
unlike
market in the world.
options on the TLT, super, super liquid.
Absolutely, this is where where almost all banks are trading short-term money. Like this is super super liquid on that front. Point being that if our listeners here, they have to choose which of the two scenarios they want to play. Do they want to play the bigger global economic slowdown and the fact that long bonds are going to be the net benefactors on the upside, or do they want a more direct play on anticipating what Powell and the Fed are going to have to advertise at some point in the coming months? Because if you want to make a pure bet on what the Fed is going to be doing, except no substitute to these SOFR futures, especially where they are. To me, this is amazingly asymmetric where we are on this on these charts, and the opportunity is there. And so you pick your poison. Like you can play it either way. There's not right or wrong. They're both great trades, but they're very different in terms of what you're actually putting your position on. And to me, I love this SOFR future trade, and I'm actually going to be leaning into this pretty aggressively.
So, Patrick, I think there's a perfect chance to go into oil, because if we see, I mean, oil tells us a lot, not only about supply, but also demand.
Yes.
Right. And if we can conclude that this price decline in oil is a result of demand, then that plays into interest rates.
Yeah.
And what you were just saying, because if we say, okay, demand is definitely going down globally, then that would increase the probability that 10-year Treasury yield declines and your base case plays out.
So I have a very specific view on oil. I just kind of in my brain try to reconcile it this way. There's only two things that you have to decide. You have to decide either A, that like the Biden administration, Trump just wants cheap oil and is going to do anything and everything to keep oil prices super cheap so the consumer is not going to get hammered by it. Or two, you believe in the drill baby drill thesis, which is that Trump wants energy independence and he wants abundance of supply of energy over the long term. In order to do that, in order to create that scenario, you need to actually have oil prices at a high enough level to incentivize all the capital expenditure that's needed to restart up all these wells and to get things going. If oil drops down to $55 a barrel, no U.S. energy player is going to be putting money to work to fire up new wells.
Yeah, and I'd like to point out, Patrick, that Chevron just announced that they're firing 15 to 20% of their staff. So to me, that's just kind of a red flag on the whole drill baby drill thesis.
Exactly. But you have to decide which one you believe in, because if you do believe the drill baby drill thesis and that Trump really wants that, then I don't think that Trump is going to want to see oil go any lower, and that this will ultimately be where the bottom end ranges of oil will be. Because obviously, if you're trying to stimulate the economy, well, shit, if oil goes down to 60, that's a bonus. You know, like it make gasoline cheaper for everybody, like get the economy going. I get it. That would be cheap. But
gasoline is already pretty cheap, isn't it? I mean, that's another thing that indicates demand.
Yeah. Well, yeah. I mean, gasoline, I think, has been quite a bit correlated. Here's the gas chart. But gas has been more or less, trading the same as oil, right? There's been, now we had a little bit of spike, but actually that's a roll in the futures contract. That wasn't even a technical breakout. This is a continuous contract. But the point here is that gasoline is correlated to oil. Point though, just back to what we were talking. Do you want to believe the one story or the other? Because if you believe that Trump wants to drill baby drill, then I actually think that oil can easily still get back to $80 to $90 a barrel, and they're going to put the carrot on the stick for all the U.S. energy players to start really building out U.S. energy infrastructure, offshore drilling, everything. Get it going. You're not going to do it down at $60 oil. And so to me, there's a big support line here. Right now, nobody's giving a shit about oil, and the story's not hot yet. And so this is one of those stories that I think if you can catch the turn point, like whether it's like Chris McIntosh and Cuppy and all these are playing all sorts of the offshore drillers, and whether you're talking the refiners, whether you're talking about some of these major oil and gas plays, they're all been beaten down pretty badly. And to me, it's going to be a scenario that if in any way that sentiment shifts, there's big money to be made there. But it's not happening yet. There's no technical reason. Like, I'm just going to pick on the Oracle of Omaha's little favorite, which is Occidental Petroleum, which is one of Warren's favorite oil plays that he's got a pile of. The thing's still at 52-week lows. This thing is dead. And at some point, if these energy plays wake up, there's going to be some big money on the upside, like take Tidewater or something like this for like these offshore drillers. These stocks have been beaten down, but there might be at some point in the end of the first quarter, going into the second quarter, there's going to be a point where these energy plays are going to wake up. And when they do, there's probably some really big money to be made on them on the upside when they start going. But it's early trade. There isn't a lot of technical evidence that the party has started yet, right? And so this is where only value investors can lean into saying, well, I think the stock is cheap enough. But there isn't a technical reason yet to buy.
Right. Okay, let's go. And I just want to point out before we move on, this isn't really contradicting your interest rate base case, because it's very counterintuitive, but usually higher and higher oil prices don't necessarily mean higher and higher inflation. In fact, a lot of times when you get disinflation, if not deflation, it's brought on, or one of the catalysts is higher oil prices.
That's
that's right, because it reduces economic activity. We saw that during the GFC. Let's go ahead and move on to Bitcoin, everyone's favorite topic.
Yeah.
The chart of the very low volatility asset.
Yeah.
Although it looks like it's a lot of vol, but we've just been in a range here for.
It's a very big range. It's a range, and what we've seen is that Bitcoin had a huge bull rip, and now it's quiet. And this is actually the enemy of crypto, because crypto, if there's any one asset that needs momentum, it's crypto, because that spurs other interest and people to chase and money to flow, and when it's not moving, then people are just not interested, and then the crypto goes into like a purgatory. The big question here is, now that we've kind of hit this upper ceiling, are we going to see something as boring as this almost 1 year long trade range that we saw in Bitcoin back throughout the summer of last year? Are we entering another prolonged period where Bitcoin is going to kind of take a break and it's going to become inactive? Well, certainly, the one thing that we've seen so far in the last month is every rally was almost immediately met with some selling, which basically means that all of that money that was in the chase based upon the Republicans coming to power, and a sovereign wealth fund that's going to own some Bitcoin or whatever kind of thesis that was running before.
Sailor mortgaging his house to buy more Bitcoin.
Exactly. So now it's really just cooled off. And with the way that the price action is, I would almost wait till the thing wakes up. I would almost rather pay a higher price and know that things at 52-week highs and know that the party has restarted up again, than to buy it here and then watch paint dry for 6 months painfully. It's like you almost wait till the momentum is there and then chase it.
And just to be clear, we're not talking about Bitcoin specifically. You're just talking about looking at this chart and whether it was oil or Bitcoin or gold or whatever.
No, we're just this is not a call on the fundamentals of Bitcoin. Let the Bitcoiners have their own fundamentals. We're just talking about the way the price is behaving. We're just talking flows.
Okay, let's go over the almighty dollar. here,
All right.
Patrick, because that is so important to global macro and pretty much everything that we talked about, whether it's the S&P 500, whether it's interest rates, I would argue even the price of gold, because if the dollar goes too high, you're going to have a liquidity event. And that would definitely be negative for gold, because I think you and Eric always talk about how in a liquidity event, the correlation of every asset goes to 1.
Yeah.
Yeah. So that's why you
This is
pay very close attention to the dollar.
absolutely. And so what we have was a huge dollar rip through October all the way through to the start of the year.
Mhm.
And now it's mean reverting and correcting. And so we often, when we use things like Fibonacci's, you're looking as to whether the thing could do a 50% retracement or some other type of a pullback. But I want to step back and look at this on a weekly chart. I want to really
Are
come
you
out there.
looking at those last past couple highs as support?
Thank you. That's exactly, you're reading my mind.
Okay.
All of these previous highs often will act as support when there's a pullback.
Got
And you
it.
can observe here that down around the 105, 106 level on the Dixie is where you're have a very natural support. And so therefore, if this is a bigger US dollar bull market, and we're about to see the US dollar head, let's say, for a retest of those 2022 highs near 113, 114, then we should see the buy on dip on a dollar happen relatively quickly. And so when you go and look at with the currency pairs that matters on, you want to specifically hone in on the euro, because the euro has broken down and is trying to kind of base out a short-term low. The pound sterling is trying to kind of bounce from a very oversold condition where it retested its 2023 low. So these are just bouncing. I like to think of it like a bungee cord tied to your feet when you jump off a bridge. Ultimately, the bungee cord reaches a point where it stretches so wide that the reflexive thing is for it to throw you the other way. And so when something gets super oversold, it's going to reflexively rally as short sellers take some profits, buy on dip traders come in, and you get that move. The big tell will be, is it just going to be a bounce or is it a change in trend? And it's very early to find out on that. In fact, I would stay generally US dollar bull bias until it's proven that something different is happening. And right now, I think approaching it that the buy on dip will work is, I think, the safest way of approaching the dollar, and assuming the dollar can still have another cycle of strength going into staying in this first half of the year. The interesting one, though, George, is what's happening in the yen. And I specifically want to talk about the yen US dollar. I flipped it upside down because the most common Forex pairing is the US dollar yen. So you're actually trading the US dollar. Here I want to look at it. So the yen is the centerpiece. This is the way the yen looks on that basis. And it really, like when you step back and look at the devastating monthly downtrend it's been basically a 15-year bear market in the yen. It literally was a halving of the value of the yen over a 15-year cycle. And here we are, this is now a weekly chart where we're seeing divergences in momentum, potential bottoming formations. The bigger question here is this finally going to be where, in the big picture, that the yen establishes a bottom? Because even though the euro, the CAD, the pound sterling, all of these currencies can still resume declining, I think that the yen is marching to the beat of its own drum. It's the one currency that is kind of doing its own thing. And it'll be really interesting.
Central bank that's actually increasing rates, right?
Yeah. And so it's a scenario at this stage where I think that everyone can watch whether the yen comes alive. But overall, I still don't want to be bearish the dollar. I mean, from a short-term basis, can it drop another full point lower? Absolutely. But on the first tap into this support, I'm going to be a buy on dip trader to try to see whether or not the dollar still has one more bull leg coming up in the months to come.
Yeah, makes sense. Patrick, tell them about your website, buddy.
Bigpicturetrading.com. It's and listen to Macro Voices, where Eric and I shoot the shit about the markets and the Market Huddle
podcast, and you got your new YouTube channel. I think Josh, is Josh helping you with your YouTube channel?
He threw up a video for me that did well, and thanks, Josh. But it's the YouTube channel, Patrick Ceresna, and so lots of great videos on there now, trying to build a little momentum for the new channel. And like you were saying, the Market Huddle podcast, where Kevin and I talk the markets all the time. There's so many ways to get access to me.
Yeah. Okay. Cool, buddy. Well, thanks a lot for your time. Enjoy Portugal, my friend.
You know where I am? I'm in Toronto.
You got to follow Patrick on Instagram. I mean,
oh my God,
he's like Tom Cruise in Cocktail.
Anyway, no, that's good. But I'm in Toronto, where it's snowing. There's like literally 30 centimeters of snow. I can't wait to get back to Lisbon. I'm trying to get onto a flight this weekend, but it's another 30 centimeters coming on Sunday. It's gonna be like, I'm literally gonna be snowed in. I've been trying to avoid the winter under all costs, and so this is a traumatic for me here. We're being back in the snow
in Toronto. You got to go have dinner with our good buddy Rich Cooper.
Yeah, exactly. I should.
He can give you some tips. He can give you some dating tips. All right.
All right.
Bombshell. Enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow rebel capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.